Today, we're going to cover how you can start investing in real estate. If you're new here, welcome to NOVARISE. And in this channel, we cover everything there is to learn about real estate investing and overall finances, so you can learn to invest either in real estate or any other asset that you would like. So first things first, you need to take a look at where you are with your finances. So in my case, before I even consider investing in real estate, the first thing I did was to check my sources of income, because I needed to make sure whether I could afford that or not. So I looked at all of the sources that I had that were either generating money for me or that had money that I have parked there. So for example, the first thing I looked at was my W-2 job. How much money was I generating, right? Then after that, the next thing I looked into was whether I had any of my money parked in any investment. So in this case, I had some money invested in the stock market, and I already had one condo that I managed to buy somewhere along the lines. But that condo, it's a story for another day. Then 3, I looked into my savings. 4, I looked into my retirement program. So at the time, my job offered a 401k plan. So for those who don't know what a 401k is, it's just basically a retirement plan where you get to set money aside and contribute towards your retirement. And sometimes your company can even contribute money towards your retirement as well. Of course, you have to stay with them an X amount of year before you can take that money with you. But in essence, that's the gist. And the next thing I look into, and I know this one is going to create a bit of a controversy, how much funds I had available with my credit cards. Because if you do this right, you can actually leverage your credit card line of credit and pull money out of there and use that money to invest real estate. So I needed to take a look at all of these 5 sources of income. The next thing I looked into was my expenses or my debt. So in terms of expenses, I looked into how much rent I was paying at the time, and I looked into other cheaper options to see if I could actually move into a place that was cheaper and help me save money. So at the time, I was actually living in one of those luxury condos. I know it was crazy, but I had to do it. I need to get it out of my system. And I was paying close to $2,500 in rent at the time. And as soon as my lease was over, I moved into a studio that was half the price, $1,250. So I was actually able to save over $1,000 and use that money to invest. So make sure you pay attention to some of your expenses and see if there's a way that you can replace those expenses with some more affordable options. Another thing that you needed to look into is your debt, right? So in this case, do you have any student loan? Do you have any credit card debt? Do you have any car loans in this case? Because you might want to look into ways to reduce that. So for example, with the credit cards, what I ended up doing is doing a lot of balance transfer from the credit cards that I have a higher interest and move them to a credit card with either a lower interest rate or just simply 0 interest rate, because that could help you pay off the loan faster. Another trick that I ended up doing was to use the balance transfer checks and then write them out to myself and deposit it into my personal account, and then use that money to pay off my car loan. That way I will save money on interest on the car. I will actually pay off the car faster, and that actually helped me be able to shop around for a much cheaper insurance rate. So I was saving money on all fronts, and with the savings that I use, I repurpose that money and use it to invest. Now, if you're in a situation in where you have a high credit card debt, you need to look into ways to lower that and improve your credit. So one way to improve your credit is actually paying that loan off, but there are other ways that can help you get an instant boost in your score. Not necessarily instant, but faster than paying it off. And one of those ways is actually calling the bank or even using your own credit card application and applying for an increase in your credit line. But only do it if the bank is doing a soft pull in your credit, not a hard pull. What's the difference in the event that you don't know? A hard pull will appear in your credit report and it actually lowers your credit score. But if you do it with a soft pull, basically what the banks are doing is just taking kind of like a cursory review in your credit, but it doesn't necessarily will appear in your credit report and it won't lower it. So make sure you request a credit line increase only if the bank is doing a soft pull. once you get that credit line increase, your score will ultimately be updated to a better and increased score. Why? Because now you're reducing your debt to income. So what is the debt to income? It's just basically a relationship of your debt in comparison to your income. So in this case, what you did, you just make your debt seem smaller. You're not necessarily making more money, but it's not the same when you owe $5,000 and you have a total credit line of $10,000 because your DTI is 50%. But if you were to increase your total credit line to $20,000 and you still owe that $5,000, your new DTI is now 25%. So little tricks like that will help you improve your credit without you necessarily coming up with the money. You still have to pay off that debt, of course, but it's just a temporary fix to help you boost that credit score. And when you get that boost, you feel a little bit more confident and it makes you want to do more. Now, you might have heard that in order to invest in real estate, you don't necessarily need to have good credit. And that's true. But when you exclude your credit from the equation, you actually limit your options. And what we're trying to achieve here with this channel is to help you maximize the options available for you so you have more choices to choose from. So ideally, I will suggest you to get a FICO score of 720 or above. Why? Because the higher your credit score, the lower risk you will seem to your lender. So when lenders look at you as a lower risk, they tend to give you better interest rates. That means your loan will become cheaper, quote unquote, because you're paying less in interest. And at the same time, you will also get the opportunity to negotiate those rates by buying points. And when you buy points, you actually can lower your interest rate. This is how a lot of real estate investors, including myself, manage to get a low rate in inflationary times. So even though you hear in the news that, interest rates are at 7-something%, I was actually able to get a rate of 4.25%. So it's all a matter of knowing what your options are. But in order to maximize those options, you need to make sure you have a good credit score. And to my standards, a good credit score is at least 720 or above. Now, what happens if you don't have a 720? Don't worry, it's not the end of the world. You will still be able to qualify for a mortgage or financing. It's just that your options will become a little bit more limited, but you will still be able to get access to financing. It's been a pleasure. Let me know what questions you have down there, and I will make sure I'll create a video that will address your needs based on your questions that you comment down below. See you in the next video. Bye-bye.